$1.2 trillion. Gone. In a single trading session. Semiconductor stocks, the sector that has been the engine of the entire bull market for the past 3 years, just turned a Friday sell-off into what at Yahoo Finance is calling a rout. The Nasdaq dropped 4.2% in a single day. This is not a normal pullback. Chip stocks are the pressure point, and when they crack, they tend to crack fast and hard. But here is the twist that makes this story genuinely complicated. The trigger was not bad economic news. It was a jobs report that was too good. May 2026 came in so strong that markets are now pricing in higher interest rates for longer, and suddenly the entire AI-driven tech trade that has fueled trillions in market value is facing the one enemy it cannot innovate its way out of: the cost of money going up. In this video we are going to walk through exactly what happened to chip stocks and why a strong jobs report triggered a sell everything moment in tech. We will look at the Fed data that hit the same afternoon and what revolving consumer credit running at 10% annualized tells us about the real economy. We will explain the May jobs report numbers and why at Axios called it a plot twist. We will examine what Meta's 6% drop on a stock sale report tells us about large-cap tech vulnerability right now. And we will zoom out to ask the harder question: is this a healthy correction in an overheated sector, or the beginning of something more structurally significant? Here is the timeline. On the afternoon of June 5, 2026, at Axios published two consecutive headlines that told the story in sequence. First, May's booming jobs report is a plot twist. Second, minutes later, markets anticipate higher interest rates after strong jobs report. The mechanism matters. A stronger than expected jobs report reduces the probability of near-term Federal Reserve interest rate cuts. In an environment where many technology and AI sector valuations are built on the assumption of falling rates and cheap capital, a jobs surprise in the wrong direction hits like a cold shower. What followed was swift. At Yahoo Finance reported that chip stocks turned a Friday sell-off into a rout, with semiconductor stocks erasing roughly $1.2 trillion in market value. The exact words used were, "This is not full market panic yet, but chips are now the pressure point." By the evening, at Axios summarized the damage with a single headline: "Chip sector bloodbath drags Nasdaq down 4.2%. That same evening, at Yahoo Finance followed with "Wall Street's hottest trade is cracking," a direct reference to the semiconductor trade that has driven the Nasdaq to its recent highs and which was now showing its most severe single-session fragility in months. Meta added to the pain. At Yahoo Finance reported that Meta stock sank 6% on a report of stock sales, a separate catalyst that combined with the chip rout to create a broad technology sector decline. On the macro side, the Federal Reserve released its April consumer credit data. Total consumer credit was up 4.8% on a seasonally adjusted annualized basis, with revolving credit, meaning credit cards, up 10.4%. Non-revolving credit was up 2.9%. The combination of a strong jobs report, rising consumer credit, and a surprise Fed rate hold expectation reset created the conditions for what happened to semiconductor stocks. The deeper story here requires understanding the specific role semiconductor stocks play in the current market architecture, and why their decline is a leading indicator that analysts watch more closely than almost any other sector. The first question many viewers are asking is, why did a good jobs report cause the market to fall? The short answer is the interest rate transmission mechanism. When jobs data comes in strong, the Federal Reserve has less justification to cut rates. When rates stay higher for longer, the discount rate applied to future earnings rises, which mathematically compresses the valuations of high-growth, high-multiple tech companies. Semiconductors are among the highest multiple stocks in the market right now because of AI demand expectations. So when rate cut expectations recede, chip stocks get hit first and hardest. According to Treasury Secretary Bessent speaking in a video statement captured by at U.S. Treasury, the economy has added 313,000 net new private sector jobs and 13,000 manufacturing jobs in the past 2 months, with firm capital expenditures rising at an annual rate of over 17% in the first quarter. While this is the administration's positive framing, it is precisely this strength that triggered the market reaction. A second pressing question is the $1.2 trillion wipeout a buying opportunity or a warning sign? On that front, the IMF's own research published simultaneously this week frames the current environment in explicitly geoeconomic terms. According to IMF News, trade and finance are being used as tools of power in an era of rising rivalry. This structurally elevated geopolitical risk premium does not disappear when a single jobs report is digested. At CFR_org's Deutsche Bank research analyst warns separately that the US-Iran conflict may be beginning the process of eroding petrodollar dominance, which, if true, represents a long-term structural headwind for dollar-denominated asset valuations that a single Fed rate decision cannot resolve. The chip sell-off may have been triggered by one jobs report, but the structural vulnerabilities it exposed were months in the making. Why did a strong jobs report cause tech stocks to crash? Strong jobs data reduces the Federal Reserve's justification for cutting rates. Higher rates for longer increase the discount rate applied to future earnings, which mathematically compresses the valuations of high-growth, high-multiple tech companies. Semiconductors, as the highest multiple AI-driven sector, get hit first and hardest when rate cut expectations recede. Is the $1.2 trillion chip sell-off a buying opportunity or a structural warning? Some analysts argue this is a healthy correction in an overheated sector and that AI demand for semiconductors is structurally intact regardless of rate timing. Others point to the IMF's geoeconomics research and the petrodollar erosion thesis as evidence of deeper structural vulnerabilities that a single rate decision cannot resolve. The answer may depend on whether the Strait of Hormuz energy disruption and US-Iran conflict represent a temporary shock or a permanent reconfiguration of global financial architecture. In the United States, the immediate human impact of this sell-off lands hardest on retail investors and retirement accounts with significant tech sector exposure. The Forbes May 2026 jobs report coverage asked a question that resonates with millions of Americans. The economy is still adding jobs, so why does finding one feel so hard? The disconnect between strong headline employment data and the lived experience of job seekers reflects a labor market that is adding jobs in some sectors while contracting in others. The very job strength that crashed chip stocks may be masking genuine structural stress for workers whose industries are being disrupted by the same AI that makes chip demand so high in the first place. In Asia, particularly Taiwan, South Korea, and Japan, the semiconductor sell-off lands with direct economic consequences. These are the countries that actually manufacture the chips whose market value just evaporated by $1.2 trillion. Taiwan Semiconductor Manufacturing Company is effectively the backbone of the global chip supply chain, and its valuation directly affects the economic security calculations of an entire region already navigating US-China technology decoupling pressure. In Europe, the sell-off combines with the energy crisis to create a compound pressure on economic outlook. European manufacturers are already paying elevated energy costs due to the Strait of Hormuz disruption. A simultaneous chip sector decline and rate expectation reset raises the cost of capital for European businesses at the worst possible moment. For the Global South, according to an IMF News analysis, the use of trade and finance as tools of power is reshaping global relations in an era of rising rivalry. Low-income countries are caught between the crossfire of a US-Iran war driving up energy costs, a potential petrodollar erosion scenario, and a chip-driven tech sector correction that makes the capital they need for development investment harder and more expensive to access. To be fair to the bulls, the case against panic here is not trivial. The strongest version of the optimistic argument goes like this: $1.2 trillion wiped in a single session sounds catastrophic, but the semiconductor sector had appreciated by multiple trillions over the preceding 18 months on AI expectations. A single session correction of this magnitude is, from a percentage standpoint, the kind of volatility that has historically been a buying opportunity rather than a trend reversal. Treasury Secretary Bessent's video statement, captured by at U.S. Treasury, outlined a picture of an American economy that by official metrics is performing exceptionally well: 17% annualized capital expenditure growth, hundreds of thousands of new private sector jobs, and a trade deficit that declined by $370 billion over the past year. If these numbers are accurate, they describe an economy with genuine underlying strength that should support long-term earnings growth for technology companies. The jobs report that triggered the sell-off is fundamentally good news for workers, wages, and consumer spending power, which ultimately drives the revenue that makes chip demand sustainable. The at Forbes coverage framing why does finding a job feel so hard when the economy is adding them points to a distribution problem, not a contraction problem. Some analysts believe the chip sector correction may actually clear the path for a more sustainable AI investment cycle by flushing out speculative excess and resetting multiples to levels that institutional capital can defend with fundamental valuation models. Here is the uncomfortable truth: the same strong economy that destroyed $1.2 trillion in chip stock value on Friday is the economy that Treasury Secretary Bessent is pointing to as proof that American policy is working. Both things are true simultaneously. The question is, which one do you want to believe is the signal, and which is the noise? Leave your take in the comments. Are you buying the chip sector dip, holding cash, or getting out entirely? If you found this breakdown valuable, hit like and subscribe. We do this every time a market event like this hits, so you understand the mechanism, not just the headline number.